You're watching the Daily Market Comment at xm.com by Rafi Boyajian. I'm Cristina Marujos. Equity markets were feeling the strain of a fresh panic about China's heavily indebted property sector after troubled real estate giant Evergrande told investors that the sale of its property services unit for $2.6 billion had collapsed. The company has until Monday to settle a coupon payment on an offshore bond as the 30-day grace period is set to expire at the end of this week. A default could have a huge domino effect on China's entire real estate market and the wider construction industry. And although it's unclear how big the international spillover would be, the prospect alone of the Chinese economy slowing even further could cast a massive shadow over the growth outlook globally. Stocks in Europe opened in the red and U.S. futures slipped. Although the renewed jitters are certainly weighing on sentiment on Thursday, markets were due for a correction following 6 straight days of gains for the S&P 500. The tech-heavy Nasdaq indices closed lower on Wednesday, even as the Dow Jones Industrial Average flirted with record territory. Moreover, Democrats are closing in on a deal on a key part of President Biden's economic agenda. In the meantime, some soothing words from Fed policymakers that a rate hike is a long way away is also likely putting a floor under stocks. Speaking on Wednesday, both Mester and Quarles suggested it was too early to start talking about rate hikes, easing the upward pressure on 10-year Treasury yields, which had climbed to 5-month highs yesterday. The recent surge in inflation expectations in the United States and elsewhere have been boosting long-dated government bond yields. But today's pullback in yields is likely to be short-lived as the U.S. 5-year break-even inflation rate has shot up to 2.9% and is showing no sign of easing. The U.S. dollar, however, edged up on Thursday as the increased risk-off drew some safe haven demand. The Japanese yen also benefited from safe haven flows, pushing the dollar to below the 114 yen level. The euro and pound both slipped too, but the biggest losers were the riskier commodity-linked currencies. The Australian and New Zealand dollars were both last down about 0.35% versus their U.S. counterpart, while the Canadian dollar was off by 0.1%, finding some support from oil prices. This was the Daily Market Comment here at xm.com.